Hello, welcome to another episode of Money Shiksha with Brijesh Parekh. I'm your host and wealth coach Brijesh Parekh. Today, we are going to discuss how to read a mutual fund fact sheet, key metrics you need to know. Navigating the intricate world of mutual funds can often feel overwhelming, especially for working professionals and entrepreneurs busy managing their careers. Understanding how to read a mutual fund fact sheet is essential for making informed investment decisions that align with your financial goals. Having spent years analyzing investment options, I've learned to decode these documents, transforming what seemed like a jumble of jargon into actionable insights. In this post, we will explore the key metrics you should focus on when evaluating a mutual fund fact sheet, drawing on personal experiences and expert knowledge to guide your investment journey. Understanding the basics of a fact sheet. A mutual fund fact sheet serves as a snapshot of a fund's performance, objectives, and risk profile. It typically includes vital information such as the fund's expense ratio, historical performance, risk metrics, and more. As you start your investment journey, it is paramount to familiarize yourself with these key components. When I first encountered mutual fund fact sheets, I was overwhelmed by the technical language and numbers. However, as I delved deeper, I realized that these metrics tell a story about the fund's potential and its alignment with my investment strategy. By breaking down each element, I was able to make more informed decisions that resonated with my financial aspirations. Focusing on the expense ratio. One of the most critical metrics to scrutinize is the expense ratio. This percentage represents the fund's operational costs relative to its assets and encompasses management fees, administrative expenses, and other costs associated with running the fund. When I began investing, I was drawn to a fund with a flashy portfolio but overlooked its high expense ratio of 1.5. Initially, this seemed manageable, but over time, the fees significantly eroded my returns. Opting for funds with lower expense ratios, typically around 0.75 or less, taught me the importance of cost-effectiveness in investing. According to Morningstar, even a seemingly small difference in expense ratios can lead to substantial differences in returns over a long investment horizon. For instance, an expense ratio of 1 compared to 0.5 can result in a 20 difference in returns over a 30-year period. Such insights have reinforced my belief that keeping investment costs low can contribute significantly to long-term wealth accumulation. Evaluating historical performance. Historical performance is another crucial metric to consider when reading a mutual fund fact sheet. It provides insight into how the fund has performed over various timeframes: 1 year, 3 year, 5 year, and since inception. However, it's vital to look beyond just short-term returns. I vividly remember investing in a fund that boasted a remarkable 20 return over the past year. However, once I dug deeper, I discovered that this fund had a history of volatility and inconsistency. In contrast, I found a fund that delivered a steady 8 annualized return over the past 10 years. This stability proved invaluable, especially as a working professional balancing various financial commitments. When assessing historical performance, it's essential to compare the fund's returns with a relevant benchmark index, such as the S&P 500. This comparison helps gauge whether the fund manager is genuinely adding value through active management. A fund that consistently outperforms its benchmark is often a sign of effective management and strategic decision-making. Analyzing fund manager experience. The expertise of a fund manager can significantly influence a fund's success. As I navigated my investing journey, I learned to pay attention to who was managing the fund. A solid track record and experience in the industry can often mean the difference between success and regret. In my early days of investing, I stumbled upon a fund managed by a seasoned professional with a history of navigating market downturns effectively. The fact sheet highlighted the manager's experience, which gave me confidence in my investment decision. Understanding the team behind the fund is crucial. A capable manager can adapt strategies to changing market conditions, helping to mitigate risks and maximize returns. Understanding risk metrics. Risk is an inherent part of investing, and understanding a fund's risk profile is vital for making informed decisions. Common risk metrics include standard deviation, beta, and the Sharpe ratio. Standard deviation measures the volatility of the fund's returns compared to the average return over a specific period. A higher standard deviation indicates greater volatility, which may not align with the risk tolerance of all investors. For instance, during market downturns, a fund with a high standard deviation may experience more significant fluctuations in value. Beta, on the other hand, measures a fund's sensitivity to market movements. A beta of 1 indicates that the fund's price moves with the market, while a beta greater than 1 suggests greater volatility. Understanding these metrics allows you to align your investment choices with your risk appetite. Finally, the Sharpe ratio evaluates risk-adjusted returns by comparing the fund's excess return over a risk-free rate to its standard deviation. A higher Sharpe ratio indicates that the fund is generating better returns for the level of risk taken. Understanding these metrics can help you make strategic investment decisions that reflect your financial goals and risk tolerance. Exploring holdings and sector allocation. The holdings and sector allocation section of the fact sheet reveals where your money is being invested. This information is crucial for understanding the fund's risk profile and alignment with your investment philosophy. For example, a fund concentrated in technology stocks may offer significant growth potential but also comes with higher volatility. Conversely, a fund with a diversified portfolio across various sectors can provide stability and reduce risk. I recall evaluating a fund that heavily invested in emerging markets. While the potential for growth was enticing, I weighed the risks associated with political instability and economic fluctuations in those regions. Assessing the top holdings and sector allocations enables you to make informed decisions that resonate with your risk tolerance and investment objectives. The importance of manager tenure. The tenure of a fund manager can provide insights into the fund's stability and potential for success. A seasoned manager with a proven track record often indicates a well-managed fund capable of navigating market fluctuations effectively. When researching mutual funds, I found that understanding how long the current manager has been with the fund can offer valuable context. A stable management team is often indicative of a strong investment strategy and consistent performance. If a fund manager has successfully navigated various market cycles, it may lend credibility to their approach and give you confidence in your investment. In summary, reading a mutual fund fact sheet doesn't have to be daunting. By focusing on key metrics such as the expense ratio, historical performance, fund manager experience, risk metrics, and sector allocation, you can make informed decisions that align with your financial goals. My journey from confusion to clarity has reinforced the importance of these metrics, and I encourage you to approach your mutual fund options with the same diligence. Ultimately, your investments are a reflection of your hard work. Make them count. Take the time to analyze mutual fund fact sheets thoroughly, seeking professional guidance when necessary. With informed decision making, you can navigate the mutual fund landscape with confidence, positioning yourself for long-term financial success. That's all for today's episode of Money Shiksha with Brijesh Parekh. I hope you found these insights helpful and inspiring. Join us next time for more valuable tips and strategies to unlock your financial potential. As always, thank you for tuning in. Be sure to subscribe to Money Shiksha with Brijesh Parekh and never miss an episode where we bring you more insights, strategies, and inspiration to help you achieve financial success.